All right, so let's continue talking about chapter 13. We have got to equity securities um, in our equity section. We've conquered the debt part. And so now we're looking at a key question here. And the key question is if we have significant influence or control. If the answer here is no, then the accounting is actually pretty straightforward. All equity investments where we do not have significant influence or control are reported at fair value, with changes in fair value included in net income each period. So this looks a lot like trading securities. So we'll record the investment at cost. After that, we report it at fair value on the balance sheet. Any unrealized gains or losses go straight to net income, no other comprehensive income. No special category, no buffering. Stock prices goes up, net income increases. If our stock price goes down, net income decreases. Also included in net income each period would be dividend income or realized gains and losses when we sell. So you kind of think of it this way. If you don't have influence, you're basically just an investor riding out market movements, and GAAP says that's fine. Let our earnings reflect that volatility. All right, this is our big picture roadmap for our, what is up there? There we go. For our summary of accounting, sorry, that's our summary of accounting for marketable investments. Basically answering one question over and over. Where do gains and losses go? So let's walk it through real quick. All right, so in our debt securities, again, held to maturity, are initially recorded at cost. They're reported at amortized cost. Unrealized gains and losses are not recognized. They stay off the income statement and out of other comprehensive income. Interest income goes straight to our net income. If we sell them, which should be rare if we're holding them to maturity, then realized gain or loss goes to net income. So held to maturity is our kind of steady, no fair value noise one. Trading, recorded at cost, reported at fair value. Unrealized gains and losses go to net income. Interest income goes to net income. Realized gains and losses go to net income. Trading means everything goes to our net income. That's where everything's headed. Available for sale, recorded at cost, also reported at fair value, just like trading. But unrealized gains and losses go to other comprehensive income, and everything else goes to net income. There we go. Now equity securities. Again, no significant influence. Recorded at cost, reported at fair value, and then just like trading, gains and losses, interest or dividends. And when we sell it, it all goes through net income. Why is it not switching slides? There we go. So why does this all matter? First, FASB says equity securities are reported at fair value with changes in fair value going to net income. So the translation there, if you own stock and its value goes up or down, that change hits net income immediately. The reason we do this is because net income is supposed to reflect economic events in that time period. If the stock went up in that time period, that's the period's performance. And the second idea behind this is trading and available for sale debt securities are both reported at fair value. So on the balance sheet, they look the same. They're both at fair value. The difference is where unrealized gains and losses go. Okay, so again, unrealized gains and losses go to net income for trading, other comprehensive income for available for sale. Minority active investments involve significant influence over the investee's financial and operating policies, and significant influence may be indicated by we have a lot of people on the board, or we have high participation in policy making, or technological dependency, The company has technological dependency on us. Ownership of 20% or more of outstanding common stock creates a presumption that we have significant influence, and then we have to use the equity method. So the equity method of accounting is used to account for investments in which significant influence exists. GAAP requires the use of the equity method when significant influence exists. Under this, the investor is going to record at cost. So same thing for each of them. We're initially recording the investment at their acquisition cost. We're going to recognize its share of the income, or recognize our investee income, increasing the investment account. We're going to reduce the investment account for dividends received or declared. And income recognized is going to equal our investor's ownership percentage of the investee's net income. So it's a little more complicated. Investors have to adjust net income to record their share of the investee's other comprehensive income, depreciate their share of fair value, book value differences in depreciable assets. And under this method, investment balance equals acquisition costs plus investor share of investee income minus dividends received. And our investor share of investee income is their net income times the ownership percentage minus any adjustments. That's all great, but it doesn't mean a lot unless we actually kind of do it. So let's go to in-class activity 13. We're going to do numbers 11, 12, 13, and 14. And we're probably going to need a spreadsheet. So on number 11, on January 1st, year 3, let's see, we purchased 300 shares of common stock at $40 per share. Prepare the journal entry to record these equity securities. So this first part, not so bad. But we're still going to go ahead and get our spreadsheet out and start taking down some info. Okay. So, number of shares. Price per share. We're going to have a total cost. Number of shares was 300. Price per share is 40. Easy peasy. 300 times 40, $12,000. So our initial cost, we'll change this to say total initial cost, is $12,000. Don't know that we actually need the formula text for that one, but we'll put it up there anyway. And we're doing number of shares times price per share. Okay. So let's do our journal entry. On January the 1st, let's see what they called it. Investment in equity securities is the account we're going to use. We're going to debit investment in equity securities for the cost. And when we purchase it, we probably pay cash. So we're going to credit cash. So anytime we're purchasing an investment security, we're recording it at its initial cost. That's how we do this. No, it's not too bad. Let's go to number 12. Okay. Same situation, same company, 300 shares of Cornet Company for $40 per share. Assume that on December 31st, year 3, the investment in Cornet Company stock has a market value of $10,500. So we're going to kind of make a timeline. Purchased on January 1st, and our cost or our price, $12,000. December 31st. Market value. It's only $10,500. We need the difference between those. So the way we want to do this, because we went from 12,000 down to 10,500, we want to take what it currently is, its current market value, minus what we purchased it at. So it's going to show us that we lost $1,500. Okay. Because we lost $1,500, when we go to record the unrealized, the account is called unrealized holding gain and loss. So when we go to record that, we're going to debit it. When we debit that account, it's a loss. When we credit that account, it's a gain. So let's go to our journal entry, and I'm going to grab the account name. Maybe if it's in here. There it is. Unrealized holding gain loss equity securities. That's the account we're going to debit. If we had a gain, we would just credit it instead. So December 31st. The difference was $1,500. So we're going to debit $1,500. And we're going to credit investment in equity securities for $1,500. So now our investment securities, our investment in equity securities account gets a credit. And since it's an asset, that's going to decrease it. It's going to show the market value of our equity securities in that account now. All right. No, we can check it if we want to. Let's go on to the next one. Same company, same situation going, but now we have something else that's going to happen. Okay. Purchase certain shares of Cornet Company, $40 per share, all that is good. Investment in Cornet Company stock has a market value of $10,500 on December 31st, year 3. So we're still at the same market value, the $10,500. On February 1st, year 4, we're going to sell our investment for $10,000. So, Feb 1st, 20 year 4, we're going to sell it for $10,000. And again, we want the difference here. So, I'm going to take what we're selling it for minus its market value. So we're going to lose $500. And sometimes that's okay, especially if a stock is going down a lot. Sometimes it's better to go ahead and get rid of that before we lose even more. So let's do the journal entry for this. We're selling it for $10,000. That means we're going to get $10,000 in cash. So in our journal on February the 1st, we're going to debit cash. And we're going to debit cash for that $10,000. Before, when we were just adjusting for market value, we put everything into unrealized gains and losses. But this is an actual loss on a sale. And so how we record that is a debit to an account called loss on sale of equity securities. We figure out how much we lost. We're going to lose $500 on the sale. So the 500 will go there. So we have a 10,000 debit and a $500 debit. So $10,500 has to be our credit side, which is the same as what is in our account as the market value. So that works out exactly like it's supposed to. Investment in equity securities, 10,500. Where is supposed to be? Yeah. Okay. So cash is going to go up 10,000. Loss of equity securities gets a $500 debit, and that's an expense for us. And then our investment in equity securities, our asset, now will have a balance of 0. And we've got that one sold. Everyone's still with me? Still making sense? Cool. Let's go to number 14. Okay, January 1st, year 2, Tiger Company purchases some shares of Eagle Corporation's common stock. Do I want to do this one yet? Hold on. Nope, we're gonna save 14 for a minute. We'll come back to 14. Let's go back to our PowerPoint. Okay. I got too zealous in putting the numbers on there. Changing ownership level. We can acquire or sell common shares, and that means we can get more influence or have less influence over the investee. So buying or selling our shares may cause an investor to gain or lose that significant influence. Remember, that significant influence number is 20%. When the equity method's adopted, the investor makes a retrospective adjustment. So we're either increasing the investment account and adjusting, or sorry, we're increasing our investment account and adjusting retained earnings for its prior share of investee income, less dividends from the acquisition date that the significant influence began. So changes in ownership level change the accounting a little bit. The balance in our investment account when we use the equity method is sorry, my brain is not working. The balance in our investment account when the use of our equity method is discontinued, there we go, that sounds better, serves as the new cost basis for our investment. So an investor using the equity method sells a portion of the investment and ownership goes below 20%, or they lose significant influence, the use of the equity method is no longer appropriate. However, previously recorded income remains as part of the book value of the investment account. So this is where things are going to kind of hopefully start to come together. Up to now, we've talked about the equity method, and that's when we have significant influence, usually around 20% or more. But what happens when influence turns into control? When an investor actually gains control over the investee's operations, we no longer just use the equity method. Okay? So, no significant influence under 20%. Significant influence 20% to 50%. Control over 50% of the shares. When we gain control of a company, or we gain control over their operations, We have to prepare consolidated financial statements. And the key idea is that consolidation means we present the two companies as if they are one single economic entity. Legally, they are still separate companies. They keep separate accounting records. The parent company still records its investment using the equity method on its own books during the year. But at the end of the reporting period, we combine the financial statements line by line, assets with assets, liabilities with liabilities, revenues with revenues, and so on. It's one unified financial picture. So even though they're separate legal entities, for financial reporting, we treat them as one company because control exists. Influence gets equity method, control gets consolidation. And that's a really important distinction in accounting. We've talked about how to measure investments. Now let's talk about what we have to tell the world about them, because GAAP is not just about recording numbers. It's about transparency. That's the important thing. For minority passive investments, let's talk about those first. Companies have to make major disclosures depending on the type of security. So first, equity securities and trading securities. Since these are reported at fair value with changes flowing through net income, companies have to disclose the aggregate fair value. So basically, what are these investments worth right now? They also have to disclose the change in net unrealized holding gains and losses included in the income statement. And these would be notes to our financial statements. Held to maturity securities are different because they're reported at amortized cost. Companies disclose the amortized cost basis, total allowance for credit losses, net carrying amount, information about the contractual maturities, and related unrealized or realized gain or loss, and what led to any decisions to sell or transfer the security. For held to maturity securities, there's a lot more financial disclosure required. There we go. 4 disclosures for available for sale securities. A little more transparency because unrealized gains and losses are sitting in that other comprehensive income section, not net income. So GAAP says, okay, if you're going to park things in other comprehensive income, you need to clearly show what's happening with it. So for each balance sheet date, companies have to disclose aggregate fair value, gross unrealized holding gains and losses, what the amortized cost is, what the total allowance for credit losses is. And so in other words, what it's worth, what did it cost, how much credit risk are we recognizing? And on the income statement side, they would have to disclose proceeds from sales and gross realized gains and losses, basis on how we determine the cost, what the gross realized gains and losses were, anything recognized when securities were transferred into trading, and the change in net unrealized holding gain and loss, an OCI. So a lot more disclosure required for available for sale securities because there's more transparency that is needed there. Okay. Not everything that sits in the investment section of our balance sheet is a marketable security. Sometimes we see things like long-term receivables, the cash surrender value of life insurance. We might see investments in funds. And this is basically reminding us that investments can mean more than stocks and bonds. These are usually created when a company exchanges property, goods, or services and accepts a note instead of cash. So let's focus first on long-term notes receivable. These are, again, created when we're receiving property, goods, or services. We assume the stated interest rate on the note is reasonable, meaning it reflects market conditions. Unless something tells us otherwise. And GAAP says that we only question it if the no interest rate is stated or the interest rate is clearly unrealistic. or like the face value of the note doesn't line up with the cash sales price, right? Question it if something looks off. So long-term notes receivable, we care about economic substance, not just what is printed on the paper. All right. A little more about long-term notes receivable. When we record a note receivable, we don't automatically use the face value. We're going to record it at its fair value. So this one's a little bit different. And our fair value is either the fair value of the property, goods, or services exchanged, or the fair value of the note itself. Whichever one is more clearly determinable. If neither of those values can be determined, then we record the note at its present value using the borrower's borrowing rate. Translation is that we discount it. Because again, accounting cares more about economic reality, not just the number written on the note. Once it's recorded, we recognize interest income using our effective interest method. That means interest revenue is based on the carrying value of the note times our market rate, not just the stated coupon. And then any impairment of a note receivable, we're going to use the CECL model that we talked about on Wednesday. So big picture, record at fair value. Accrue or interest, record interest using effective interest rate, and then test for credit losses under CECL. Okay, now let's go to Cengage and finish that up. Ooh. Or at least 14 and 15. Well, it's just easier if I do that. Okay. Just show the whole thing. Please stop. What is going on there? Okay. Gosh, weird. January 1st, year two, Tiger Company purchases 6,720 shares of Eagle Corporation's common stock. Eagle had 22,400 shares outstanding. On that date, the following information pertained to Eagle. So we have book value, and we have our fair value for our assets, other non-depreciable assets, liabilities, and we have our shareholders' equity. During year two, Eagle earned a net income of $120,000, paid total dividends of $48,000. So prepare the journal entries of Tiger related to its share of Eagle's net income and dividends in year two. All right, so let's get some info down. Ooh, there we go. That might be too big. That's probably too big. Okay. On January 1st, 20 year two. We purchased 6,720 shares. Figure out if that is significant for anything other than one specific piece of this. No, not really. Okay. They had 22,400 shares outstanding when we purchased those. So shares outstanding, 22,400. So our ownership, 6,720 divided by 22,400. We own 30% of the company. So again, significant influence in the company. No, equals, I don't know why I was doing a sum. That was weird. Was it C3? Okay. So our ownership is 30%. So the first thing we want to record is our investment in stock of Eagle Corporation. On here it says that they earned net income of 120,000 and paid total dividends of 48,000. So net income is 120,000. So this is going to be our total column. This is going to be our portion. So we need to multiply the net income by 30%. So our portion of this is $36,000. So that's what our investment in them was worth. So let's go to the journal. First journal entry we're going to do on December 31st. Investment in stock, Eagle Corporation, $36,000. Investment income, $36,000. So we've made $36,000 in investment income in year one. Okay. That doesn't make any sense. Why are we dividing that by 8? Oh, 8 years, that's why. All right, so we need to record hold on. That doesn't look right. My notes where I figured this out now don't make any sense. That's what happens when I do this 2 or 3 days before. Oh, okay. They're depreciable assets. We have to record some depreciation based off their depreciable assets, right? So their depreciable assets have a fair value of $620,000 and a book value of $600,000. So to record this, we want to get the, I'll go down a little bit here. I'm gonna kind of make the same little part of the same chart they have. Book value, fair value. I don't have enough zeros. So we need to find the difference between our fair value and our book value. Fair value, 620,000 minus the book value of 60,000. Now we need our portion of the difference here. So this 20,000 is what still needs to be amortized. So our portion of that amortization 20,000 times 0.3 or 30%. But this is still happening over the next 8 years. So we need an each year part. So each year that we own 30% of the company, unless they get more depreciable assets, we're going to recognize a loss of $750 in our investment income. So going back to our journal entry. To record that, we're basically doing the opposite of what we did here. Right? We recorded our investment in their corporation, and our investment income went up. Our investment income is going to go down a little bit also here on December 31st to record that amortization. So investment income going to go down by $750, and it's coming straight out of the investment in stock for Eagle Corporation. Last piece of the puzzle here. They sent out a dividend of $48,000. So we get part of that dividend because we own 30% of the company. So, man, stop going over weird places. Dividend. 48,000. I did too many zeros. 48,000. Our portion of it, 48,000 times 30%. So we're going to get $14,400 in cash for our dividend. So to record receiving that dividend on December the 31st, if we're going to get cash is going to go up $14,400. And the other part of this is investment in stock, Eagle Corporation. So our portion of their income, our portion of their depreciation, and our portion of their dividend. All right. Let's check our work. That looks great. We'll go to 15. Let's get all our information at 15. On January 1st, Kilgore accepts a $20,000 non-interest-bearing 5-year note from, can't read that up there, from Dylan Company for equipment. Okay. So we have a note that's $20,000, 5 years. Neither the fair value of the note nor the equipment is determinable. Kilgore had originally purchased the equipment for $18,000. So original purchase, $18,000. The equipment has a book value of $14,000. Book value, $14,000. Kilgore knows Dylan's incremental borrowing rate is 9%. So incremental borrowing rate, 9%. Okay. Prepare the journal entry for Kilgore to record the sale of the equipment on January 1st. So Kilgore is selling some of their equipment off. Okay. Does it give you? It does give you a present value table. Okay. That's good. We're gonna need that in a second. All right. We have to figure out the present value of the $20,000 note. So on the present value table, it's 9% and 5 years. So the present value of our note, or the present value of 1 in our table, is 0.649931. I'm going to copy that. And we're going to put present value factor in our Excel spreadsheet. So to figure out the present value and the discount, we're going to take the original amount of the note, so our $20,000, times our present value factor. So the present value is 12,998.62. And then our discount on our note receivable is going to be the note, the original note, minus that present value. Okay. So let's start figuring out see, I'm trying to think if there's anything else we need to figure out, and there is. The accumulated depreciation. Our accumulated depreciation would be our original purchase, just minus that book value. I'm going to throw all these formulas in there. I think that should be everything we need to figure this out. So, try to get this all on here at once. Bless you. So the first thing we're going to do on January 1st, we want to debit our notes receivable account for the amount of the note, which was $20,000. We also want to debit accumulated depreciation for the amount of our accumulated depreciation, $4,000. We're going to skip a line because that's going to be our loss or gain line. We're going to record the discount on the notes receivable. And that's our 7,000. Oh, everything popped up. Our $7,001.38. Nope, that should not be a debit. That should be a credit. Put it in the wrong spot. Oh, gosh. There we go. 7,001.38. And we're going to credit our equipment account because we're selling that equipment and it's on our books for $18,000. So 20,000 plus 4,000 is 24,000. 18,000 plus 7,000 and 1.38 is not 24,000. The difference there is about $1,001.38. No, sorry, it's more than that by 1,001.38. So we're gonna have since we have a debit there, we're gonna have a loss on our sale of equipment. Okay. Very last problem that we have. We're gonna do this one real quick. This one's not too bad. We are purchasing some insurance on our officers, and it has a cash surrender value. Let's see, we paid 12,000, cash surrender value of 8,500 to $10,000. So on January 1st, we're going to record the annual payment. And then we're going to do the adjustment to recognize the change in surrender value and record interest expense on December 31st. We don't actually need anything else for that. So to record purchasing an insurance policy on our officers, we want to debit prepaid insurance for 12,000, just like we would if we bought a normal policy or any other insurance. Credit cash for 12,000. That's the normal part. That's us purchasing it. On December 31st, we need to change the surrender value. So on here it says that the cash surrender value of the life insurance policies increased during the year from 8,500 to 10,000. So we went up $1,500. So on our second line, cash surrender value of life insurance. It increased 1,500. We're going to have insurance expense. We'll get that in just a second. And we have prepaid insurance. So it looks like we cashed in one of these and it went up $1,500. Originally cost us $12,000, not $120,000. That's dumb. There we go. So 12,000 minus 1,500, our insurance expense gets $10,500. You want to know more about insurance on officers? There's a couple of slides at the end of the PowerPoint you can read about that. That is it, though.